Welcome back, everybody. This is your designated Inquirer. My name's Axel, and today is 7/21/2020. And on today's market day, we've got quite a few things to go through. One being that the Nasdaq went ahead and tried to reach the maximum, the local maximum of its recent run-up from the March lows, which also happens to be its all-time high. So if we can go back, basically take a look at this year, we see that the March lows were down here. This was our pre-March in February. These were our highs, and this is where we're at basically right now. So as far as the market is concerned, it basically got rejected at a level of $2.50 from the high. So it was an after hours trading. We basically went to that level. We closed around here. We went up after hours, internationally speaking, during that trading time, and it got rejected at 11.058. So it actually got within, looks like 50 cents. At the time, before I went to sleep, it seemed like it was only at $2.50 from the top. But if this is the case, then that's fine. Then that means it got within 50 cents of the high. So getting that close and missing it, a lot of times for investors, it means that the market just didn't have enough strength. And they basically ran out of buyers, and they were more fearful up at that range to be able to buy higher, thinking that they could sell it even higher. So there was nobody effectively available to confidently say, hey, I think I can sell this for higher if I buy it at its highest price it's ever been. Nobody did that. So they came in within 50 cents of that price and then started selling off. They basically said, you know what, I'm happy here, I'm going to take my profits. And so began basically the sell-off into what happened today. During the day or in after hours, a couple companies ended up reporting. Snapchat, United, which is a airline, and one more company, which was Best Buy. Best Buy reported well. I don't know the particulars of that particular stock in terms of like what their details were. United Airlines reported okay. They were basically Snapchat was in line with the estimates and projections, even though there was no guidance given. But in terms of forward guidance for future subscriptions and current subscriptions, they missed some current subscriptions, and they were saying that future guidance and or like future subscriptions was something that, in terms of marketing, etc., and being able to keep eyeballs and or prices per eyeball, was not secure. It's like they didn't feel as confident as being able to keep up the momentum they've had up until this point. And so Facebook went along and dropped along with them after hours. So that was kind of interesting to see. So maybe like these tech giants and these marketing behemoths don't have as much clout as they thought they did. Something else that I thought was super interesting today was during the day, in talking about like basically the Nasdaq, as to how 5 stocks basically equated the next 50 different stocks that made up the Nasdaq in terms of net worth, and how it's basically top heavy as an index, overly weighted on basically 5 stocks, and how that's a really high danger for the index and all the other indexes that also happen to include them. And what would be the premise as to why they would deteriorate in terms of price? So I had to think about it for a moment, and while they've been having some basically increased sales and because they've become essentially more necessary during this pandemic. What is happening is that during their run up, during these last 10 years, what has been happening is that their services, mostly like for companies like Apple, Google, and a few other ones, Nvidia, things that produce physical objects and technology, the costs of those things have been increasing rather dramatically in the recent years. To be able to say that we now have $1,000 phones, etc., and that everybody wants to have them is one thing. But people were more or less running out of their own money to be able to buy them outright. For a long time, we've been basically relying on credit and our credit ratings, individual credit ratings, to be able to buy them and purchase them from our like individual carriers. Now, what would be a disruption to that demand and or ability to buy and continue to buy was if individual consumer credit was affected. And so I was interested now to see whether or not individual consumer credit was being affected by the pandemic, by this crisis. And it turns out it is, because if you're unemployed and if you're only receiving unemployment, can you really report that as a reliable income to the credit agencies? Are they willing to extend credit when you basically no longer have a job, and whether that job is in question for the future? For a lot of people, the answer is no. And just to make it crystal clear, the data from the Fed, which collects this data and puts it out, basically has a running tally from basically the 2000s all the way to last a couple months ago, the end of May 31st. So this data tracks basically in terms of percent and you in terms of dollars. So you're able to see basically the rise and decline, where your blue line is your percent, basically increase or decrease, and your total consumer credit is in red in terms of dollars. So if you want to see the total dollars, etc., you look at the right side where you see the number in the millions of dollars, and then you've got percentage on the left side if you wanted to compare the numbers, or etc. whatnot. So running across, we have a somewhat of a baseline, an average baseline of consumer credit running basically at around 15,000, or in this case, at the top side of, we look at it, it would be about halfway through from 20 to, from here to here, it'd be about 10. So is it 10,000, 10 billion worth of consumer credit. After the decline in 2008, where we had a recession starting in 2007, basically consumer credit was the thing that declined the most, which is why we partially had that recession. A lot of people couldn't afford their homes anymore. Their credit had to be slashed, and they couldn't buy their homes. And so a lot of people, the market collapsed, because now the ability to buy had declined to such an extent that the homes were no longer affordable. Credit tightened up dramatically. The amount of documentation that you had to present increased. So credit to the Fed's efforts that they try to keep credit available still had to contract as a necessary function to keep the market healthy in the long term. So that's why as part of receiving TARP funds, etc., in terms of passing Glass-Steagall and a bunch of other things, basically credit had to be tightened up. The restrictions to be able to get credit got tightened up, so that the ratings for the debt that was being written by the credit agencies was valid, and so that the system could function once again, because before it was effectively running off of fraud. What's happening now is not necessarily the same, but there is still a problem in terms of credit. Not necessarily the credit that you would use to buy a home, but personal credit in terms of things that you would buy. So if you can't necessarily get credit or have a good credit score because, well, you don't have any money and you don't have any income to speak of, your ability to buy is now reduced. Are you going to be able to get the new iPhone? Are you going to be able to get the new Xbox? Are you going to be able to get all of these consumer products, these subscriptions? Do you want to be able to get Spotify, Netflix, Disney Plus, Hulu, and all these other things and stack them up? Like, are you going to be able to do that month to month unless you have to put it on a credit card? Because now the credit card companies aren't going to give you that credit because you don't have any income. You're going to be able to run it up for a period of time, but then you're out. You're done. You're capped at your limit. And if you're in that boat, you're probably just going to be trimming those things and you're going to get what you basically can. You're going to hopefully have your landlord not evict you. And you're going to be buying food because that's what you need to live. You don't need Spotify to live. You don't need Netflix to live. You don't need Disney Plus to live. You don't need a lot of things. A lot of things are basically going to be getting cut. And you don't need that iPhone. If your phone still works, if it's still trudging along, if that battery is kind of shitty, but you know what? You don't have a choice. You're going to deal with it. And so even though they're going to be putting out a phone every year, this year is probably going to be the year that you're probably not going to get it. And that's where the case for a declining Apple, maybe not Facebook because Facebook is free, but then again, are you going to be able to pay for internet at that point? Who knows? Well, if you're not going to be buying stuff, the way Facebook is affected is that the marketing dollars going out to advertise and try and get your dollars are not going to be as effective, and so they're not going to be paying those marketing dollars. That's how Facebook is going to be affected. Nvidia, are you going to be able to get that $400 graphics card? I don't think so. Amazon, are you going to be able to buy as much stuff as you have been before? Probably not. Microsoft, do you need Microsoft Office with that computer that you probably need to Zoom to like your next job interview? Probably not. It's probably something you're going to be skipping out on. Like, or you're not going to get that Xbox, you're not going to be able to pay for that Xbox Live subscription, or like there are other subscription services for games. Like, there's a lot of things that are going to be falling by the wayside that have been for a long time discretionary income or discretionary spending, but now you don't have that discretionary income to justify those purchases. So in terms of the downfall and for a case as to why these particular companies could see a retraction in price is for this very reason, is that the economy is going to come back to bite them. And a giant tell for why and how that is through consumer credit, being able to read consumer credit. And at the worst of the financial crisis last time around, credit declined by less than 10% at its worst. Okay. Now you may say, like, well, it's only showing May and there was a steep decline, but there was another increase to about 5%. And so you have to start to measure maybe the area under the curve, which may be affected by this time. But we're not done with the decline yet, because coming in October, a lot of companies that were handed PPP money that maybe don't want to keep getting PPP money and or desperately need to start shedding jobs to be able to survive as a company are going to start doing it in October. So maybe the government offers PPP money into the end of the year, or maybe for a couple months, or who knows how generous they're feeling. But some companies are just going to straight up not seek out that PPP money because maybe they feel more comfortable firing people to be able to save money and basically turtle up till they see the end of this crisis, which could be early 2021 and by the worst of it not until next summer and or maybe next winter, because even though people are going to be able to roll out the vaccine, the adoption rate is uncertain. How quickly we to get it in the hands that of the people that need it is not certain, and the actual efficacy of these vaccines is also not certain to the general public. As good as a 30,000 person phase 3 trial might be, we still don't know what the actual effects of the vaccine will be. And so with all those variables out there, and that we do see a concrete effect on consumer credit falling by slightly more than 20%, which is astronomical. I don't think the market, on the day that this information came out, the market did not react to it. So I'm skeptical that the market is even looking at this as a point of contention to their current valuations. So that's basically it for today, guys. That's what I'm seeing right now. That's the things that I'm worried about. Those are the things that I'm looking at in the market. And yeah, so to recap, Best Buy reported, United Airlines reported, Snapchat reported. While United Airlines was basically in line, Best Buy reported well. There's still retail, and it's still not, if they were reporting numbers, who knows as to whether they talked about the end of June, early July, consumer behaviors. And Snapchat, which is a tech social media company, was basically casting doubt on their future potential earnings. And that's why you saw that decline that spilled into Facebook. So all those things super important. And until next time, you guys stay safe. And this has been your designated Inquirer talking about the market day. My name's been Axel. You guys take care now. Bye.